All right. I want to say welcome to everyone who is joining us on today's webinar. Today, we're going to talk about something really exciting. I know it's an exciting topic for a lot of people because it is one of the most common questions that I get when I'm talking to our investing clients is how can real estate investing, how can investing with a firm like ours, how can investing in multifamily real estate as a passive investor in a syndication benefit me and a tax standpoint, right? Because we all know making money is great, but there's that saying. I don't know who said it, but it's one of my favorite quotes. It's not how much money you make; it's how much money you keep. And there are really powerful tools out there as investors that we have, especially in the real estate space, to help us keep more of what we earn. And cost segregation using companies like Madison Specs as operators has helped us pass those savings on to our passive partners. So really excited to talk about this tonight. I won't steal Matt's thunder, but I want to say welcome to everyone. If it's your first time here, we host these webinars on a monthly basis. Sometimes it's just me chatting for 45 minutes, and sometimes we're lucky enough to have a awesome guest speaker like Matt, who's here today, one of our trusted vendor partners who we use for all of our investments, come and educate our investors on sort of how these things work. So I want to say welcome if it's your first time here, and make sure you follow us on YouTube. We're always posting this content on YouTube. So if you don't get to catch it live or if you have to fall off for any reason, just look us up, follow us on YouTube. We usually get this posted the next day. And then make sure you're signing up for all of our future webinars as well so you can stay educated. Let's move on. Let's jump right in. So quick disclaimer before we dive in, this webinar is for educational purposes. It's not legal or investing advice, and we always advise that any of our investing clients speak to their professionals in their network before they make any type of investment. Always consult with your attorney, financial advisors, things of that matter. Just because these tax benefits, we're sort of speaking on a high level, everyone's personal tax situation is very different. So you don't want to assume something you hear or see today is exactly going to apply to you, apples to apples. So always consult your professionals. A little bit about us. If it's your first time here, again, welcome. My name is Brian. I'm the Director of Investor Relations here at Headway Capital. I have the pleasure of speaking to all of our investing clients who have actively invested with us and the ones who are thinking about investing with us. Our shop, our firm, we're based here in Houston, Texas. We were built and designed to help protect the wealth of busy professionals by offering investment opportunities with a focus on commercial real estate and an even deeper focus in multifamily real estate. So we are multifamily apartment investors, and we help investors achieve financial independence and financial freedom by investing in these projects and getting things like cash flow, getting things like equity upside, and of course, getting things like tax benefits. And our team has extensive experience doing this. We've been doing it now for the past 8 years and have been investing in real estate itself before we got into the multifamily syndications for more than 10 years. So if you know Sid, Sid's our founder and CEO. He started Headway back in 2018 for the reason we're speaking about today. He had a tax issue, was making good money in his corporate career. His wife's a doctor, but she wasn't out of school yet, so she wasn't making any money. But they started to have a tax issue because they started buying rental houses, and they got up to 30 plus houses and realized, like, holy cow, we have a tax problem. And that's when they started passively investing in syndications, which eventually led to us starting Headway Capital. I already introduced myself, and then Umar, who's our CFO, Chief Investment Officer, he's the one who looks at all of our numbers and makes sure all of our books are in order. So definitely a valuable member of the team. A little bit about us. We have a little over 450 million of assets under management, which equates to about 3,000 units. So we've been doing this for some time, and our target focus is always to try to double our investors' money in 5 years. So we shoot for a 25 to 30% average annual return, and we have over 500 active investing partners with us today. We got a few testimonials here on screen. If anyone is thinking about investing with us and you haven't spoken to me, please get a call scheduled today or after this webinar. I'm happy to talk more about our investors' experience and how we provide a white glove treatment to all of our investors. And then we got some examples on here of some deals we've closed on the past few years. Got a mix of some variety of deals. Got some value add deals here on the screen, but some are a little bit newer, some are a little bit older. But these are the types of projects that we like to offer our investors. So if you're interested in participating or at the very least learning more about these types of investment opportunities, please again schedule a call. So without further ado, I'm going to kick it over to you, Matt. So you could talk about your favorite subject in the world, cost segregation, and how investors can benefit from a tax standpoint by taking a part of the cost segregation in these types of projects.
Awesome. All righty, Brian, I really appreciate the introduction. Yeah, so I'll share my screen now and start with my slides. Alrighty. Okay, all right. Brian, again, thanks for the introduction. Thanks for having me. Again, my name is Matt Clark. I work for Madison Specs, and all we do is cost segregation. So Brian and Headway's Capital's job is to make you the money, right? But that's really not the name of the game. Although they do a very good job of doing that for their passive investors. So that's where my role comes in, is helping you save some of that money, because that's really the most important part at the end of the day. And that's just why so many sophisticated investors love real estate in general, because it not only makes you money through cash flow and appreciation of the asset you invest in, it also helps you save money through depreciation. So I always like to start off with a visual. So this one might be a little silly for you all, but this is straight line depreciation. So this is what you'll get with your CPA. They give you just a very, very small percentage of what the depreciation you could have. And this is depreciation with cost segregation, right? So I know not everyone's a cheeseburger fan. It's just something a little silly. And that might be too big of a bite for some people, but in real estate, there's never too much depreciation to be had. So a quick overview of just what cost segregation is in general. Also, I'd like to mention just very briefly, please feel free to ask any questions in the chat anytime. And Brian, if you could keep an eye on the chat and just let me know
Absolutely. Yep.
if questions do pop up, we can stop anytime for questions. So just a quick overview of what cost segregation is in general, is we're breaking out different components of the asset and putting them on another depreciation schedule, right? So we're taking your asset, your apartment complex, your multifamily unit, and segregating different pieces of that asset, right? So we're breaking it all down into line items, if you will. And we reposition those into 5-year and 15-year assets. And then with multifamily, we lead the rest into a 27.5-year depreciation schedule. So that's kind of what this looks like here. So we'll start with the value of the asset, subtract land value, and that gives us a depreciable basis that we start our cost segregation with. And at Madison Specs, we do 5-year and 15-year property. So the 5 years is going to be personal property. So you have a ton of that in multifamily, right? So you'll have, and this is just a very brief example of what's included in there. It's not a comprehensive list by any means. But if you have 100 doors, you have 100 fridges, right? You have 100 washers and dryers sometimes. You'll have 100 pieces of flooring, 100 pieces of countertop, a whole host of things. And then in 15-year property, which you have a ton of in multifamily as well, especially in the types of investments Headway makes, would be land improvements, right? So all the asphalt and curbing outside, all the pavement, all the sidewalks, fencing, landscaping, even things like playground equipments and pools can be included in that as well. So that's just things on the outside of the asset, land improvements. Here's another visual for you all. So in cost segregation, you actually don't save more in taxes. You save more quickly. So if you added all the blue bars and all the green bars up, it would equal the same amount of number. But it really just puts an emphasis on time value of money, because $1 a day is worth more than $1 tomorrow. So you have the bigger benefit more quickly. And when you're selling or flipping a piece of property every 5 to 7 years, that's more important. So you're not going to hold it for the entirety of the 27.5 years. So that's why cost segregation is so beneficial. So yeah, just some quick overviews of the benefits of cost segregation. Is reducing the tax liability, increasing your cash flow, and improving that time value of money. These are just some very brief examples of what Madison Specs has done. So for Headway's case, the two on the left are going to be multifamily. Okay, so we are in an era of bonus depreciation at the moment. So cost segregation has been around a long time. I'm not sure how familiar anyone is with the term bonus depreciation, but it got passed in the 2017 Tax and Jobs Act. So in 2018 to 2022, there was 100% bonus depreciation. So whatever that 5-year and 15-year reclassification were, you could take all that benefit in the first year, 100% of the 5-year and 15-year. It's now being phased out, and we're now at 40%. One caveat to this would be there is lots of talks, lots of very positive talks from the congressional level to reinstate 100% bonus depreciation that has not been officially passed quite yet. It looks like it will. It looks likely to pass. So if you were to use Madison Specs and get a cost seg study done, tomorrow, for example, and you only captured 40% of your bonus depreciation, you won't have to do a new study to get the retroactive 100% bonus depreciation, we'll walk you through that process. So I can't speak to all cost seg firms, but Madison Specs will most certainly walk you and your CPA through that process of how to recalculate and get the full depreciation you're owed. So just a quick note there. And that just, this again, this is in the era of 100% bonus depreciation. So you just see how significant of a saving you might get in that first year. And so now we're at only about half that, but still, there's still very, very large savings to be had. Okay, so a couple quick questions some of you might have. Who should do a cost segregation study? And in our opinion, it's any real estate investor. So individuals, estates and trusts, corporations, partnerships, LLCs, and most importantly, syndications as well. So here is, I'm going to spend a little time here. So there is two different types of investors in real estate. Well, more than two different types, but on the broad terms, we have active versus passive investors. So on the top left, you'll see W-2 income earner, non-real estate professional status. So that's something you'll need to speak with your CPA about. Again, like Brian mentioned, this isn't the be all end all of everything, and not every rule applies to every single person. But as a whole, this is good guidelines to go by. So if you are a high income earning W-2 earner and not a real estate professional, which a vast majority of the time, if you do have a W-2, it's going to be very, very hard to qualify for real estate professional as an individual. So you won't be able to depreciate your W-2 income. However, you will be able to offset your passive income, essentially making most of, if not all of your passive income 100% tax-free. So especially if you have in syndications. So yes, you'll still be eligible for bonus depreciation, but again, it will be used towards the passive income. And just like any depreciation you get from bonus depreciation, regardless of your investor status, your losses carry forward. So it's not a use it or lose it type thing. You have it indefinitely until you relinquish ownership, aka sell your ownership in the real estate stake. So this will be passive investors, similar to the one above. When you're not a real estate professional, you won't be able to use it against your active income, but you will be able to use it towards the passive. So that's the big thing. So Brian makes you the money on the passive side. I'll help you save the money as well. So pretty similar guidelines there. Now this is where people really, really save a ton of money. If you're a passive investor in a syndication, but your profession is active to real estate professional. So you will be able to offset a portion of your W-2, especially if you have a spouse that is a material participant in your real estate ventures. You can also, and then the same rules applies for depreciating against your passive income. And yes, you're always eligible for bonus depreciation. So this is the one thing you're going to want to speak to your CPA about if you have any questions, would be this 750-hour rule, because I know the IRS is pretty strict about that. Basically, this means throughout the year, you need to have 750 hours of material participation in your real estate ventures, right? And then the last would be being an active investor. So you're a material participant, but you're also not a real estate professional, which I would say is less common. There's probably not too many people like that, but feel free to put in the chat if you think, if you feel like you're in that category there. So this is a brief example, very, very simple elementary numbers that we're going to use here. So, but it gives you a good idea of what your tax break might be should you invest with Headway. So we just did simple, a $10 million, multifamily unit in and around Houston, Texas, or Texas in general. We're typically going to take about a 15% land allocation, which would give us an $850,000 depreciable basis. We're also making a lot of assumptions here. So we did an 80-20 LP to GP split. And we also assumed a 3.5 equity raise. So again, there's plenty of numbers to mess with here, but it's just try to give you a broad idea of what your investment might save you. So say you were to make a $100,000 investment, and with our cost segregation study at Madison Specs, you're going to have a 22% cost segregation split. That is I would say a low average for multifamily. I think the types of property Headway invest in is a little bit higher than that, but in general, multifamily is going to be anywhere from 20 to 35% on the high side. So this gives you the LP ownership of 8 million. So basically, if you invest 100,000, you would end up with 2.86% ownership stake. And this is really just the main thing to look at here. So I used an example date of July 15th as well, because the closing date is going to affect how much you get in that first year. So it gives you 169 days remaining in the year. And then this bottom blue number is really the most important number. So it would give you a $21,000 tax deduction year one. And even if you didn't have that much in passive gains, again, it rolls over indefinitely. So here are some case studies that we've had done with, oh, sorry, I forgot to change that from the last presentation, but just look at these bottom numbers here. So again, this just shows you an example, a nice little visual of what it looks like from the high level overview perspective. So again, $10 million apartment complex closed June 18th, gave us a $9.1 million depreciable basis. This one was about a 35% cost segregation split off percentage. So back to my cheeseburger reference earlier, this is what you would look like if you just went straight with your CPA. If Headway just went no cost segregation study, everyone would be splitting $180,000 of tax deduction. However, when they use Madison specs, we can bump that number up to $1.6 million. So I think that gives you a pretty good idea of how powerful a cost segregation study might be. And here's just another example. 11 million, 10 million, 136,000, excuse me, would be the no cost segregation study tax benefit. So not very much to go around for everyone investing. However, this was last year, this example. So we're 60% bonus depreciation, so 20% higher, and that gave us a $2.1 million tax deduction. So almost, yeah, more than $2 million was the difference for cost segregation in that case. So what is the best time to do a cost segregation study? So it actually is directly after the acquisition, according to IRS. That's when they're going to want to see it done. So within, about a month or two is when you're going to want to start doing that, and most certainly before any major renovations. Although we can still work with you on that if you have started renovations. A lot of people don't know this. You can actually do 2 cost segregation studies or more on a property if you make a significant enough renovation or addition to the property. So we did one where there was a storage unit on the front end of the property, and they just built more storage units on the back. So we did another cost seg study for them. Also, if you're doing the renovation aspect, need to be included in the personal property and the land improvements. So if you're doing a major renovation on the siding and the roof, good for the property, good for your valuation, but not going to be so helpful on the cost seg side. Obviously, a newly constructed property, do a cost seg study. Those are actually pretty simple for us to do for you. But if it's not too late, we also have a thing called a look back study. So if you have previously purchased a property and want to learn more, we can still work with you. All we're going to do is need a form from your CPA capturing all the depreciation you've already taken, and it'll be the same number for the cost seg. We just subtract your previous tax deductions. So I have a lot of people come up to me and they've watched like a 5-minute YouTube video on cost seg and they think they know everything about it. So I hear a lot of myths and misconceptions about cost segregation study. And this is just kind of the top few. So a lot of people say my building is too old for a cost segregation study. The age of your building actually has almost no factor whatsoever in a cost seg study, because once the ownership changes hands, the depreciation schedule starts all over. So it could be, in 1900 brownstone in New York, but you just bought it, you have a 27.5-year depreciation life cycle. So it doesn't matter how old the building is at all. I hear this a lot too. My CPA handles all the depreciation for the property. True, right? We saw earlier the little mini cheeseburger. That's typically, I would say, if not 85, 95% of the time, what your CPA is doing for you. If you've never heard the phrase cost segregation study or engineered study from your CPA, it's more than likely you're just getting that small straight line depreciation. So 1/27th of the depreciable basis. So they'll plug in your tax numbers for sure, but if you're going to want to ask them if they've done a cost seg study. If they haven't charged you for one, most likely, again, like I said, they're not doing this for you. This is one that scares people a lot of times too, but it's nothing to worry about. I can assure you of that. Is doing a cost segregation study will red flag me for an IRS audit. So the only time we've ever had to go to court to protect our clients is when they got audited for something else, right? And then the IRS saw they did a cost seg study, and so they wanted to talk about it. So a cost seg study is not going to raise any red flags as long as you do it right and do it with a proper company, right? So as long as I wouldn't recommend ever doing this on your own. So I used to say you never want to cheap out on shoes, tires, or mattresses. Now that I'm in the cost segregation world, I also say you don't want to cheap out on things that deal with the IRS. So just make sure you're using a good, reputable firm, and you'll be fine. So what are the downsides though, right? It can't be just 100% beneficial. So the one downside to cost segregation is going to be recapture. Because what cost segregation, that tax deduction, essentially what it boils down to is almost like an interest-free loan from the government. So they're giving you the benefit to use that capital elsewhere, right? To inject it into the economy and keep the ball rolling. So once you sell that property, you'll have to pay a recapture, right? So as long as you're working within a 3 to 7 year window, the recapture penalties, or it's not a penalty, but the recapture on your tax deduction is going to be almost, you're not going to notice it at all. So that's why we always tell flippers, stay away. Like if you know for sure you're going to sell this in a year, do not do cost segregation study at all. So anything 2 years or less, I typically recommend stay away. Again, with Brian and Headway, they aim for a 5-year hold period. So that is right in the sweet spot. So you're going to be just fine. You don't have to worry about recapture. Very quickly about Madison Specs, the company I work for, this is all we do is cost segregation. So this is a little outdated, I apologize. So we actually have closer to 70 professionals on our workforce now, 5 full-time CPAs that are double checking and triple checking all of our work as we go. Most of our executive group comes from Big Four accounting firms. We're actually closer to 30,000 studies done nationwide and closer to 9 billion in tax savings. The Madison difference, one aspect of that would be our smart tours. So we've just found a very seamless, very non-intrusive way for the investors, for the property managers to get these tours done. So you can reach out to me to hear more about that. And very quickly, I work for Madison Specs, but I'm actually part of a sister company. I'm a sister company of Madison Commercial Real Estate Services. We're also a title company and a 1031 company, as well as a lease pro company. So basically, if you have any commercial real estate services needs, feel free to reach out and I'll get you in contact with the right person. Awesome. And this is how you can reach me directly. Cell phone is the best way for me. Feel free to shoot me a text and connect with me on LinkedIn.
Awesome. Cool.
So I'd
Great
love to
job.
answer any questions anyone might have. But yeah, Brian, thank you so much for having me, man.
Yeah, great job, Matt. So I just want to kind of recap everything because I want to make sure we're all on the same page
Yeah, it's a
here.
lot, right?
Yeah, it's definitely a lot. So we as the sponsors, as a general partner in these investment opportunities, we are always going to do a cost segregation study on our investments just because, like you mentioned, we are modeling typically a 5-year hold. 7 would be the absolute max. 3 would
Yeah,
probably be like the fastest, right? We're not really in the fix and flip kind of business when it comes to
right.
these large apartments. So we are the ones that are responsible for doing the cost segregation study, right? So
Mhm.
investors do not have to come to you individually as
Yeah,
an
that's
LP.
one good point. It's one cost seg study per property. So and that,
Right.
that just gets divided up ownership percentage. We
Right.
don't have to do
So
100 cost seg studies for one property.
right.
Good
So
point.
nobody has to call you unless they're
Cool.
buying their own apartments, right? Or they own, a lot of residential houses.
Yeah.
And
Yeah, Airbnbs and such. But yeah, as far as
right.
your organization, you got it taken care of for them for sure.
Correct. So we work with groups like you to take these studies. We do them. We are always getting a preliminary analysis. So one of the things you'll
Mhm.
notice when you partner with us, and we fired you over a couple deals we did last year, is when we go under contract, from an execution standpoint, we always email you guys and say, hey guys, we're under contract. can I get a preliminary study done? In which you guys, from 30,000 foot view, because you're obviously not at the property, your engineers aren't there, you're gonna kind of run some rough maths and give us some call it
Yeah, I call it
roundabout
our
ballpark.
algorithm. Yeah.
Yeah, ballpark numbers on, $100,000 investment is going to get this type of return. It's going to be close. It may not be exact, right? But
Yeah,
that's
and
going to
we're
help.
also usually pretty conservative as well. So we usually try to go a couple percent
Yes, yes. And then
better. But
I've actually exchanged emails. I don't know if it was you or somebody else before. I almost felt like it was too conservative. I was like, hey guys, like this is a little too conservative,
yeah, yeah, we like
which
to
is good,
under
right?
promise and over deliver for sure.
That's right. So if you tell an investor they're going to get, $40,000 of depreciation year one, or 30,000, whatever the number is, and then they end up with 25, they're super upset, right? Or
Mhm.
if it's the other way around, if it's actually 45, or if it's $5 or $10,000 more, they're happy. So we like that about you guys, that you guys are more
Yeah.
conservative, even though we're always trying to kind of push the needle. But
Mhm.
we're going to provide all of our investors that report, usually on the offering memorandum that we offer our investors, and then for us, we're always ready to pull the trigger as soon as the deal closes. We get that cost seg study done, because we want to provide that to our CPA, so that when he does all the K1s, everyone
Mhm.
gets their slice, right? So is there anything execution wise that I'm missing there, Matt, that investors sort of need to understand how it works? They don't have to lift a finger. We do all the work, which is one of the benefits of partnering as a passive investor. They just got to get their K1 at the end of the year, and that's what'll show the depreciation they were able to capture.
Yeah, from your perspective, like if being a passive investor with Headway, I mean, there's nothing for anyone to do. Just reap the benefit. So I was just trying to give like broad, how it works for any individual. But yeah,
Yep.
you're right. As long as they're working with you, you got them covered, and there's nothing for them to do or no action for them to pull. Yeah.
Yep, perfect. One big question I want to ask, and you kind of touched on a little bit, and I get asked this a lot, and I say, hey, I'm not the guy to ask for this. And feel free to share your opinion personally, and then also maybe what the company's kind of hearing and thinking.
Okay.
I get asked a lot about, is 100% bonus depreciation coming back? I've
Yeah.
seen some of the things that have gotten passed but haven't made it all the way through, and I think we all kind of were hoping slash wishing, anticipating that once Trump was elected, whether you're a fan or not, it's irrelevant. He's a real estate
Yeah, because
guy. We
he's the
know
one
he's
that passed it originally, right? So.
exactly right. So he's a real estate guy. We know he likes this policy. He's the one who passed it originally, to your point. We had a feeling something would come back. And I've seen already rumblings about, I think any properties purchased in 25, and beyond, they're trying to push to be able to even retroact, to the 40% this year. Tell me a little bit
Mhm.
about, what do you think is going to happen? Where's that bill sort of at? And then what are you guys kind of preparing for internally? If that bill is passed, I'm sure you'll be getting. I mean, your business. The
Yeah,
good
I
thing
think this
about your
phone will be
business
ringing.
is, I mean, I'm not going to say it doesn't slow down, because the transactions slow down. It slows down for you, but
Yeah.
your services are always needed.
Of course. Yeah, so I mean, I don't want to get anyone's hopes up and be like it's gonna pass next week, right? We all thought when he got elected it was gonna pass pretty quickly. So what, we're about almost 6 months in, and the needle hasn't moved any further. It hasn't gone backwards for sure. Like in my personal opinion, it will pass. Everyone in my industry is hoping it's sooner rather than later, right? But I would hate to speculate and be like and tell you it's gonna be by the end of the year, right? It might not be until the whole thing's phased out. Unfortunately, it could be a year or two, right? But um, we're hoping it's gonna be sooner. It's already been on the Senate's hands already, so we're hoping to see that pass sooner rather than later. Like we mentioned, regardless of how you feel about the current president, he's the one that passed this in the first place,
Yep.
right? And it is really good for the economy because the people like in your position, even in like small time like Airbnb investors, you could be the smallest, fish in the pond. It's still very, very beneficial for you because you save all that money. And if you're in real estate, if you're trying to grow a portfolio, what are you going to do with it? You're going to throw it back into a new property, right? So it helps the economy keep going. And from my business perspective, I can tell you what I will say. I'm 90% sure if it does pass, it's going to be retroactive. So
Hmm.
I do think that. So if it does pass, it's going to be back up to 100%. And then I would imagine it'd be like a new phase out schedule, right? So it would be maybe next year's 80%, or it could still be 100, and then after that it'll phase back out.
Yeah.
But what I can, yeah, from the company perspective, we're ready to work with you and willing and able to get you and your CPA on board for that to capture that 100%. Should we get in an era of retroactive bonus depreciation?
Yeah, and I don't think people realize, like, It's a big deal. I mean,
It's
you showed
huge.
some math
It's
earlier that
huge.
showed you showed some math earlier that was $20,000 of depreciation benefit on a 40 percenter, right? We'll double that and throw some more on there, right? If it's
Yeah.
back at
Yeah.
100%, right?
Yeah.
So
Yeah.
it,
It's a
you know,
big difference.
it's a huge difference. And I have personally invested, and this is more of an anomaly, so I don't want to say, you should be looking for this, but I've invested in some deals back when it was 100%, back when, 2019, 2020, 2021, and I've put 100K in a deal, and and just these are kind of like anomaly deals where you get really large numbers, like 70, $80,000 of depreciation, right?
Hmm.
I mean, these are huge numbers that you can
Yeah. It
get.
almost doesn't make sense, but
Yeah, it almost feels too good to be true, which is why I guess they put it on a phase out schedule. But if you're an investor and we're able to retro, depending on how far they allow you to go back, even if it's this year or the year before, I mean, even just going forward, right? If they say, hey, this is a 10-year thing, and the
Mhm.
first five are going to be 100%, and then it's going to step down after that, right? It's like get as much in as you can those first five
Yeah,
years
because the
when it's
last
100.
one was what, almost 4 years, right? So
Yeah,
18 to 22.
exactly. It
That's
was pretty
longer, yeah.
long. That's tremendously powerful because, to your point, if you're not able to use it all in one year, it just rolls over,
Right.
right?
You don't
And
lose it. Yeah, you
and you
don't lose it
don't
until you
lose
sell
it,
it.
right? And then if you're an active investor, and let's say you're investing in one project a year, two projects a year, these things are eventually going to sell. The more you have sort of in the piggy bank, the better it is when you actually get all that you get all the profit, right? From a profit
Hmm.
from a sale, right? So it's one of those things. It's a beautiful thing, but you got to keep the snowball going because if you
A
stop
hundred percent,
investing
a
and
hundred
then
percent. And I'm not going to say, cost segregation is the only one that was lifted the market, but if you look at the market in 2022 and you look at the market now, I mean, it's still different, right? So,
yep,
that's a piece of the pie for sure.
yep, absolutely. Tom has a question. He said, if you own three properties purchased this year, will you get three times the benefit? So I'm not quite sure.
Not you won't get it depends on what you bought, right?
Yeah,
So yeah, but you can get a benefit from each, right? I'm not gonna say it's
correct.
3x or what, because it depends on the properties. But if you bought three of the exact same property, then yeah, it would be 3x, but it just depends what you own. But yeah,
Yep. So
you can get the benefit from each for sure.
right. Each project, each LLC will get its own cost segregation study done, and they could all be different, right? So some assets that are newer, I know like vintage plays a role in the segregation of and the numbers and kind of that stuff too, right? Like a 2020 build is going to depreciate differently than a 1950s property, depending on renovations and all that stuff. So the numbers
Right.
will definitely vary, but you will get three separate
Yeah, it depends
depreciate.
what's there. It
Yep.
depends, like that land improvement. That's like for multifamily, it's huge, right? Because you have giant parking lots, giant amounts of curbing, giant amounts of fencing, giant amount of lighting, typically a pool, typically a playground, right? If not more, if not even more, a gym, all that kind of stuff. So that's like it's just a bunch of tiny little numbers that just are keep adding and adding up. So again, yeah, it just depends what is on your property, what you've purchased. But yes, you will receive the benefit three times, but I'm not going to go as far as say 3x. But yeah,
Yep.
it'll look
Makes
pretty
sense.
good for you. Hmm.
Makes sense. Question I get commonly too around this is we have a lot of residential investors that sometimes have
Hmm.
large portfolios, 10, 20, 30, 40 houses that are looking to start passively investing, or they're transitioning to being an active investor too as well.
Hmm.
When would you say that cost segregation makes sense in the residential space? Is there like a line in the sand? You got to have at least 10 houses. Can you do it for any old, $300,000 house that's an investment property? What do you guys typically see, or what do you
Yeah, yeah.
recommend?
So I would say Madison specs threshold is going to be about 500,000, right?
Okay.
But that's not to say if you buy a $250,000 house, you can still do a costing study. We focus in commercial, right? I've done homes, I've done Airbnbs, my company's done um, own to rent communities, right, where they have 40 or 50 at once. So that will be like a portfolio sell for us. So we're more than willing to work with you on that. But I don't think if you just own one residential home and it's at like a 250 to $450,000 range, I wouldn't recommend Madison Specs, honestly. But you most certainly can still get a cost seg study, and feel free to reach out to me and I can point you in the direction of who to use for that.
Yeah, definitely. I know you guys would be able to help. Like, I sometimes meet investors, they might own like 20 homes and they're each 250K,
Yeah.
right? Or something like
Yeah,
that.
so
That's a,
it also logistics is part
yeah,
of that too, because it's like who's going to go to the home, like are they all in the same area?
yeah.
So feel free to reach out and just run me down your specific um, scenario, and I can take care of it for you, or I can get you someone who can for sure.
Yeah. And
But
Matt, can you
yeah,
also,
don't shy away from cost study no matter what.
yeah,
There's a company out there for you
that's what I was going to say too. Is the other thing, we also work with a lot of business owners as our investors. Can you talk a little bit about the other types of assets? Some people think cost seg is like exclusive to multifamily.
No, I
You can
would
cost
just
seg a
say,
lot of things.
yeah, you can literally any real estate investment. So the only caveat is it needs to be open to the public. So you can't buy a rundown warehouse that's all boarded up and that no one uses. So it doesn't have to have a tenant, but it has to be open to the public. So you have to have some proof that you're advertising it's for lease. That's really it. So it can't be run down and boarded up. It needs to be available to the public. So that's one caveat. But yeah, no, any real estate investment. So anything that's not your personal residence can be applicable for a cost segregation. I would say in this era of syndications, it's just such a powerful tool because they kind of get to spread the wealth out to so many more people. It's just because it's kind of become a little buzzwordy, I guess you could say, because some people have a misconception of it. But it's a very powerful tool in syndications. So I think when people are presenting for multifamily, it's just for someone to become more synonymous with that. But
Yep.
it can be a warehouse, it can be, a strip of 3 townhomes that you own and rent out. It can be literally anything.
Car wash, strip
Car
mall.
wash, gas station,
Yep.
um, what's like a boat? I can't think of the.
Oh, RV storage.
Yeah, RV storage,
Yep.
um, anything, anything that you're renting out or using and owning and operating out of. Yeah.
Good to know. Yeah, like I said, we have several business owners that invest as well, and maybe
Mhm.
they don't know about this. So hopefully, they have a good CPA that's saying, "Hey, you should be doing this." Um,
That's I always get scared when people say I have a good CPA because
yeah,
typically when we finally get them on the horn and get them showing, that's when they've not taken the benefit they could have been taking for many years. Yeah.
absolutely, absolutely. So
Like I said, if you've never heard the words cost segregation or engineered study with your CPA, I would ask them about it for sure.
absolutely, absolutely. Well, this has been very insightful. Good information. Hopefully, people learned a lot about cost segregation, sort of how it works on the back end, why it's really powerful. And the thing I just want to highlight is we do all the work. You guys do all the actual work for us. We pay you, and then we pass the results and the benefits on to all of our passive partners. So if you haven't invested with us, feel free to reach out to me. I can show you some of the material you've shared with me, like past examples of
Mhm.
preliminaries, and then I can talk a little bit higher level about some of our previous deals and the cost segregation results we've gotten out of those. And then, of course, they can always connect with you to speak about any particular projects that they might have. But
Anything. And then I would just like to mention very briefly taxes. If you have a question about real estate taxes, just come talk to me. I'll get you the right person. So whether that be, contesting your property taxes, you want a CPA that knows real estate, cost segregation, I'm your guy.
there you go. There you go. So reach out to Matt. He's a resource at your disposal. Don't be shy. He's always been really responsive, you and your team, whenever we need something. So we appreciate all you guys do and the benefits you create for not only ourselves as a sponsor, but our investors as well.
Anytime, Brian. Appreciate it. Thank you.
Awesome. Awesome. Well, I appreciate everyone for joining us tonight. Please make sure you sign up for our next webinar. We're gonna do a Q2 market update where I'm gonna be talking about multifamily market update and what's going on, what we're seeing both in the world and the economy, and then of course in the multifamily industry. So I want to say thank you to everyone for joining and hope everyone has a good night. Thanks again, Matt.
Thank you. Thank you.
Yep. Take care.